Recording. Right. So, good morning, everybody. Welcome to 2026, the year of the fire horse. So, I think this year is going to be quite different to our previous years. But I think 2026 is going to be, well, the theme of the year is going to be regulatory change. And I think this year is going to be, we'll be seeing more regulatory change than we've probably seen in the last decade. We've got MTD going live, we've got the Companies House reform, we've got benefits in kind being ramped up for launch next year. And this is all happening under the umbrella of AML supervisory changes as well, which I'll talk about, give you an update towards the end of the coffee morning as well. But while well, for me, every time there's change, I see opportunity. So hopefully we'll be able to support you through these changes and let you benefit from those. So we have two speakers this morning. We have Thomas Harris from Begbies Traynor, who is a licensed insolvency practitioner. So hi, Thomas, thank you for joining us. And we also have Diane Wright from Croner-i, who'll be talking about MTDs. So Diane will be going first. Let me just introduce her. So Diane is a senior technical writer at Croner-i Tax. She has a wide range area of expertise covering employment-related securities and investment income, including venture capital schemes such as the Enterprise Investment Scheme, tax compliance and administration, and certain areas of company tax. She is a product champion for all the tax tools. So Diane has spent almost 30 years working in tax, following a decade with KPMG and PwC, dealing with large range of clients. Diana has spent almost 10 years working in the in-house tax teams of the FTSE 100 company. She then rejoined the Big Four for a time before joining a smaller firm in Edinburgh, dealing with a wide variety of issues, largely based around OMBs and their shareholders, and with a particular focus on employment-related securities and funding under the Enterprise Investment Scheme. So, Diane, over to you. And as usual, if people want to put some questions in the chat, I might answer them some as we go. If not, we'll have some, we'll save the questions to the end of Diane's talk, and then we'll go through them then. Over to you, Diane. Oh, Diane, I think you might be on mute. Diane, I can't hear you. Have we got a technical issue?
Hello, everyone.
Okay, there we are. I can hear you.
Hooray! It's a bit of a relief. I thought my talk might be curtailed somewhat sooner than I intended. Thanks for that introduction. Unfortunately, you might be able to tell, I'm more used to Teams than Zoom and got caught out there on mute. Yeah, thanks for introducing me. It's a bit of a mouthful. And one thing that it didn't make clear is that I now, of course, am spending a lot of my time dealing with the mandatory introduction of Making Tax Digital, which, of course, is why I'm here with you this morning. First up, apologies. I'm recovering from a cold. I'm going to try not to splutter at you too badly. So bear with me. This is an update session. Where are we now on Making Tax Digital? Well, you probably all know that the system is currently being tested. Its first mandatory use is going to be in April 2026, less than 4 months away now. And at the current time, the rules are still generally in draft format. Have been evolving quite a bit. They're not even static in recent months. Most recently, of course, at the budget in late November. And HMRC's guidance, which has historically been skewed towards the voluntary testing participants in the scheme, is now changing significantly in order to meet the needs of those mandatory users. And the rules, of course, applying to those are actually a little bit different. So until now, things haven't really been entirely satisfactory for those of us who are trying to prepare to help our clients with using the system from April 2026 onwards. the guidance is now being fleshed out significantly. So just a quick refresher then, when do taxpayers start using the system? Well, as you no doubt know, mandatory use is beginning in stages, depending on the level of the taxpayer's qualifying income. That means the aggregate of all relevant income, not profit, from self-employment and property, as shown on the supplementary pages of their tax returns. So the self-employment pages and the property income pages of our clients' tax returns. The first wave are joining on the 6th of April 2026. These taxpayers are those who had MTD relevant income of over £50,000. And to work out whether this is the case, you look at the last tax year for which a tax return was due to be submitted before the 6th of April 2026. Hence, you'll generally be looking at the 2024 to 25 tax year here. The second wave are joining on the 6th of April 2027, and this cohort consists of those with qualifying income of over £30,000. This time, of course, the tax year to look at is again that last tax return which was due for submission before the start of the tax year concerned. So it's going to be 2025-26. The final wave are joining from April 2028. They'll have qualifying income, again, self-employment and property, over £20,000, generally in this case in 2026 to 27, and based on what was in their tax return for that year. Now, as things stand, the system will eventually apply to taxpayers with qualifying income of over £10,000 and to partnerships too. But we don't yet have any further details on that or the date when it might apply. And as a quick aside, although I'm dealing with MTD for ITSA this morning, the original intention was that as well as VAT and income tax self-assessment, MTD would eventually apply to corporation tax as well. However, that's now been scrapped. HMRC have recently been writing to taxpayers who they know have exceeded those income thresholds in 2024 to 25 to let them know that as far as they're concerned, they're due to join the system in April 2026. However, they won't have information to write to taxpayers in all cases, and they're quite clear that it's taxpayers' responsibility to determine if and when they're required to join the system, and to do so even in the absence of any communication from HMRC. One area which has changed significantly in recent months, to be perfectly frank, it was until quite recently as clear as mud, is that relating to exemptions from MTD for ITSA. Some of these exemptions are intended to form a permanent feature of the system, and we'll run through those first. Some others, in contrast, are available only during the early years, and then they'll no longer be available. Essentially, they provide a deferral for certain categories of taxpayers while the MTD system kind of speeds up and becomes able to deal with certain areas of complexity. Let's look firstly then at the digital exclusion exemption. Taxpayers could be digitally excluded, for example, for religious reasons, or alternatively for practical reasons. That is, they can't reasonably comply with the system because of, for example, their age or a disability that they may have, their location, or for another reason. The digital exclusion exemption generally needs to be applied for under a process which is now open. So for taxpayers who would otherwise be required to join in April 2026, if you think they may be digitally excluded, you need to be applying now. HMRC will look at each application on its own merits, but they won't accept that a person is digitally excluded in certain cases. For example, because they previously filed on paper, or because the system would involve an additional burden for them. Alternatively, if the person themselves is digitally excluded, but they have an agent who can comply on their behalf, again, they will not be regarded as digitally excluded. I said that an application is generally required for this exemption, and that's quite correct, but there is one exception. If the taxpayer is already exempted from complying with MTD for VAT, you should contact HMRC. If HMRC agreed that the circumstances haven't changed, the taxpayer will also be exempt from MTD for ITSA. Note, however, one point here. Taxpayers who are exempt from MTD for VAT due to insolvency won't be exempt from using MTD for ITSA. If HMRC, on reviewing the application, agree that the taxpayer is digitally excluded, they'll issue an exclusion notice, and the taxpayer won't need to comply with MTD for ITSA while that's in force. If they don't agree that the taxpayer is digitally excluded, they'll write, of course, setting out their reasons, and you then have 30 days to appeal. If the circumstances change and the taxpayer is no longer digitally excluded, you again have 30 days to let HMRC know of that change of circumstance. Moving on now to some other categories of taxpayer who are permanently, some other exemptions. This is an important distinction, isn't it? Some other exemptions which form a permanent fixture of the MTD for ITSA system. Firstly, taxpayers who are already within the MTD for ITSA system and indeed have been within that system for at least the last 3 tax years. Such taxpayers are exempt from using MTD for ITSA for a tax year if their total MTD relevant income for each of 3 previous tax years was not more than £30,000. So, for example, those who are required to join from April 2026 onwards, but then whose income fell over the subsequent tax years. This exemption will apply from the start of year 4 following the 3 tax years concerned, and it will only apply if the taxpayer opts out of the MTD for ITSA system and notifies HMRC accordingly. Now, HMRC's guidance at the moment only refers to this £30,000 threshold, but it seems to me that, of course, that will need to change in due course to £20,000, and then presumably, again, it'll need to reduce thereafter to £10,000 as the income thresholds for mandatory use of MTD for ITSA reduce over the coming years. The remaining categories of exemption which will form a permanent feature of the rules are as follows. Firstly, taxpayers who can't complete the identity verification procedures required to sign up. They won't need to comply until their situation changes. This will generally be the case where the taxpayer can't obtain a national insurance number, but it may also apply in other cases where the verification procedures can't be completed due to circumstances beyond the taxpayer's control. And this exemption will apply automatically. Non-resident companies are automatically exempt, and trustees are exempt from using MTD for ITSA when acting in their capacity as trustee, of course. And the same will apply to the executors of someone who's died. This exemption, again, generally applies automatically. But if the situation only comes into effect after the start of the tax year concerned, the person will need to notify HMRC in order for it to apply. Taxpayers with an unrevoked, lasting or enduring power of attorney are also exempt from using MTD for ITSA. And again, that's going to be automatic, except for if the power of attorney only comes into force after the start of the tax year concerned, in which case the person will need to let HMRC know. And this is just a recent one announced at the budget. Taxpayers who lack mental capacity, awful phrase, to make decisions for themselves in circumstances where a deputy in England or Wales or the Scottish or Northern Irish equivalent has been authorised to make decisions on their behalf by the courts. Now, we don't know anything further at this stage about that exemption, but it seems logical to me to assume it will work in the same way as the others. That is, it will apply automatically unless it only comes into effect after the start of the tax year, in which case HMRC will need to be contacted to let them know. And that's it for the exemptions forming a permanent feature of the system. I mentioned that there are some temporary exemptions, and the list of these grows over time. These defer the start date for certain taxpayers. Firstly, some taxpayers who'd otherwise join in April 2026 won't now need to join until April 2027. These are taxpayers who claimed farmers or artists' averaging relief, taxpayers who claim qualifying care relief, that's typically foster carers, taxpayers who have income from trusts or estates, and taxpayers who use the SA 109, that's the residence supplementary pages of the tax return. Now, in each of these cases, the exemption will apply automatically if the relevant circumstance was in existence and was disclosed within the taxpayer's 2024 to 25 tax return. Where it wasn't, the deferral should still be available, but it will need an application. Unfortunately, the application process for these temporary exemptions is not yet open. The last category of taxpayer to whom this 1-year deferral is available is non-UK resident entertainers and sports people. And this category will always need to apply to HMRC, even if the fact pattern existed and was disclosed in their 2024 to 25 tax return. And the following categories of taxpayer can benefit from a temporary exemption which will last until at least April 2028. Ministers of religion of any religious denomination, recipients of the married couples allowance or blind persons allowance, and Lloyd's underwriters. Now, there's a bit of a quirk here because although Lloyd's underwriters are wholly exempt from using the system until at least April 2028, their underwriting activities are permanently excluded from MTD for ITSA. So although if they have other MTD relevant activities, they may find themselves within the system from 2028 onwards, they won't need to report their Lloyd's underwriting activities via quarterly updates. Now, each of these exemptions work in the same way. They'll apply automatically if the 2024 to 25 tax return included the fact pattern concerned. If it didn't exist in 2024 to 25, the exemption will need to be applied for, and the application process isn't yet open again. One final point, HMRC's guidance refers only to the 2024-25 return here when determining whether you need to apply. But it seems to me that that's only relevant to determine whether the exemption will apply automatically for 2026 to 27. So for 2027 to 28, logically, it seems to me you'd need to look at the 2025 to 26 tax return. We don't yet know whether that's the case, but it does seem to me that it should be. It's not yet spelled out in the guidance. I would hope that they'll improve that as time goes on. There's quite a lot to know about those exemptions. As I say, there's been a lot of movement recently. So with a sigh of relief, let's move on to a quick overview of some administrative aspects of the system that we now know more about than we previously did. First of all, signing up. Taxpayers should sign up for MTD for ITSA before their digital start date, so before April 2026 for that first wave of mandatory users. Where there are multiple relevant income sources, you'll have to check on the online account that each one is within the online MTD for ITSA service and add any which are not shown. It's important to note that this is because you don't just submit one quarterly update for each taxpayer. A quarterly update is required for each MTD for ITSA relevant business. Before signing up a client to MTD for ITSA, you first need to ensure that they're authorised as that client's MTD for ITSA agent, and that authorisation is reflected within the agent services account. Note that this is a different thing from the online services account. That's helpful, isn't it? The agent first has to obtain the client's permission to sign them up, of course, and you have to explain the system, including the penalties regime, to them. HMRC are not going to be providing software for making MTD for ITSA. A software package will be needed. The software can act in one of two ways. It may itself be able to create and store digital records within it, or alternatively, you can keep the records elsewhere and the software may bridge or connect with those records elsewhere. Typically, of course, they're going to be within a spreadsheet. Software which bridges to the taxpayer's own records has to be digitally linked to those records to enable the transfer to take place. And this digital linking needs to be done before you submit a quarterly update to HMRC. Taxpayers need to authorise their software within their government gateway account, and this authorisation procedure needs to be repeated every 18 months or so. Software packages should provide a reminder to taxpayers to do that. When there's a change of the software package, of course, you have to ensure that you can still access all digital records. And it's also important to note that making digital record keeping requirements apply on top of the existing record keeping requirements. So you also need to keep records in the usual way. Provided you change your MTD software at the end of a tax year, there's no need to import digital records into it from previous tax years. You just have to make sure you can still access them. If, however, the change of software takes place during the tax year, the digital records for the current tax year do have to be imported onto the new software, or else manually recreated on it if it can't be done automatically. So how will your role as agent work under the new regime? There's a few things to be aware of. There are two agent roles for MTD for ITSA, the main agent and the supporting agent. Taxpayers can only have one main agent at any given time, but they can additionally appoint one or more supporting agents. And they don't need to have a main agent in order to appoint a supporting agent, or indeed vice versa. The role of the main agent is pretty much what you'd expect. They can do all of the tasks that are needed to run the client's MTD for ITSA annual compliance cycle. The only things that the main agent can't do are set up a direct debit and change the preferred contact method. Supporting agents have less functionality. They can't submit the digital tax return or view tax calculations, for example, and they can't see their clients' income sources which are not relevant to MTD. Note here, of course, that a client may have a different supporting agent to look after each of their businesses. So, for example, one for rental income and a different supporting agent for their sole trade. HMRC that they can't restrict what each of these supporting agents can see to the business which is relevant to them. So in this case, both supporting agents will be able to see the records for the rental business and the sole trade. We'll all need to learn how to liaise and support each other where we're acting as part of a team for the same client. HMRC refer to the MTD for ITSA agent authorisation process as the digital handshake. For new clients, you'll be asked to confirm when you're requesting authorisation via your agent services account, whether you're going to be the main or supporting agent for the client. And the client will then receive a consent statement setting out what you'll be able to do for them to agree to. Agents who've already signed up a client for MTD for ITSA in the agent services account, or who are the pre-existing self-assessment agent for a client, will automatically be regarded as the main agent for those clients. But you do need to check that that authorisation is reflected in the agent services account as well as in the online services account. And if it's not, it needs to be copied across. There are instructions for how to do that on HMRC's guidance now. I appear to have gone over my time a little bit. Apologies for that. I don't know if you want me to deal with any questions just now or to feed them back to me afterwards. Happy either way. I hope that this has been a useful update session for you. I have had to be quite selective about what I could include because a lot has changed of late and it does continue to change. I'm expecting for the speed of change to continue in the coming months. I'm happy to conduct any further sessions that you might like in the coming months. If you can think of any particular aspects of the system that you would like to have a deep dive into, just let me know. Thank you very much for your time.
Amazing, Diane. Thank you ever so much. And yes, we'll take you up on that offer because, as you say, things are changing quickly and we're in the final straight as well. So if anyone's got any more questions, please drop them into the chat. I've got a question for you actually. In your view, what do you think is the biggest misunderstanding about the MTD income tax mandate and what should we be doing about it?
Oh, it's well, in general, I think HMRC's guidance, understandably, is not great at this stage. So it's really difficult to single out any particular areas. I spend really unhealthy amounts of my time looking at HMRC's guidance in more detail than I would like to. And it is rather defective in a number of areas. I did an article about this recently, actually. And for example, it's so general sometimes as to be not useful to those of us who know what we're talking about. And I know that I'm talking to an audience of sympathisers here. For example, it talks about how the requirement will be based on your turnover. Well, it's not in all cases, because turnover and income aren't the same thing. And until very recently, focused on voluntary users, and the rules that apply to those are not the same as for mandatory users. It all feels rather hastily implemented. I do find it unlikely that those with income, not profit, of over £10,000 are going to be able to use the system, or indeed whether they should use the system at any point in the foreseeable future, or indeed how it bring partnerships with all of their complexities within the system. I would advise you to, in terms of what we should be doing about it, as I said, you're required to explain the system to your clients before you sign them up as part of the permission process. I would have a document. It's that usual practice protection thing, isn't it? Have a document which you hand out to them at the same time as you verbally explain what's going on, and make sure that you keep it on file. And that's what springs to mind immediately. I'd be happy to provide more thoughts if you like.
Okay. Dan, if you can just, the article that you spoke about, is that a digital copy? If so, can you just drop that into the chat so that people can be signposted towards that?
I think you've already seen that my IT skills are not of the highest water.
Okay,
but
I'll
certainly...
No,
I'm being flippant, just in case it doesn't. Yeah, I'll certainly try and do that. I'll try and find it just now, and I'll drop it into the chat.
I have just one question here. Well, actually, there's a couple of questions. Sorry, just to close off with your talk here. Angela says, does gross turnover include pensions? Assume it does. And Cheryl says, no. No, exactly.
No, it doesn't. No. Just to be absolutely clear, it is only income from self-employment and from property businesses. So that's UK, and for UK resident taxpayers at least, it's from self-employment and UK and overseas property businesses. Of course, overseas residents can be within MTD for its only where they have income which has to be reported within the UK. So for them, overseas property businesses, for example, wouldn't be relevant. But pensions income, savings income, dividend income, they are not relevant to MTD for ITSA.
Okay, thank you. Joyce has just made a reference that HMRC themselves appear to be confused about turnover and income, I think, as well. So,
yeah, it's a real bugbear of mine. It makes me feel slightly pedantic. I think my problem with it, of course, is that HMRC are, I mean, they are using the terms fairly interchangeably, but they do say, you know, we base it on your turnover. Then you look at the self-employment supplementary pages, there's a box for turnover, and there's another box for other business income, which is not included in turnover. Now, it's quite clear that both of those boxes are to be included when you're deciding who's in and who's out, but that is not clear from HMRC's guidance. So that could trip up taxpayers, and it could also conceivably trip up agents. So watch out for that one.
Okay. Thank you. I suppose my observation on this is the lack of awareness still in the business community. So, as you know, we're working more and more with the London Chamber of Commerce and Industry and talking to many of the SME members of that organisation. There is still a shocking amount of people that are still not aware that this is becoming mandated this year. So I think that's a challenge which HMRC is sharing with us, really, to communicate as well. I think we're becoming their spokesperson to share this.
Yeah, inevitably, as a technical writer, I get rather shut away in my ivory tower. You know, as I say, I'm spending a lot of my time dealing with MTD for ITSA, and so I perhaps fondly imagine that everybody else also is entirely abreast of what's going on. I do know, of course, from bitter experience, what life in practice is like, and how difficult it can be when you're busy on the day-to-day to ensure that you're looking 6 months ahead at the same time. I would urge everybody on here to ensure that they are having a look through their client list and finding out who's going to be affected from April 26 onwards, and making sure that they're ready to deal with it on behalf of those clients in advance of April 26 and getting those sign-ups done.
Yeah, absolutely, I agree. Thank you, Diane. If anyone has any questions, please continue to put them in the chat. Mariska will gather those questions, and outside of this meeting, we can respond as well. So thank you, and over to Thomas. So good morning, Thomas. Thank you for being here. So Thomas works with Begbies Traynor, and they sponsored our awards a couple of years ago as well. So we've had a long-term relationship with the organisation. But Thomas, he's worked in Insolvency since 2008, qualified as an IP in 2019, and activated his licence to act in 2022. He started out in a small boutique firm as an office junior, moving through the ranks and passing all exams before moving to Begbies Traynor. He now works closely with directors and advisors to spot issues early and takes a practical approach to navigating clients through them. Thomas has a passion for SMEs, with this being the focus of his work, but he's also well positioned to assist larger clients. And since sponsoring the awards, the IAB Awards, Thomas has taken member inquiries and early guidance calls. And today he is sharing the key red flags bookkeepers first see, how director loan accounts can be handled properly. That'd be interesting. And when to refer early for a quick sense check. So over to you, Thomas.
Hi, thank you for that, Sarah. Good morning, everybody. So I've put together a few slides for us to go through. I'll propose taking 10 minutes, and then if I could take questions at the end, that'd be fantastic. I'm more than happy to answer any questions that you've got. So yeah, I've been working with the IAB, as Sarah mentioned, since I think it's just over 2 years now. And we've had quite a few calls, which I'll come on to. But I guess protecting your practice growth is something that's just as important. And actually, if we catch a client with an insolvency event, this could actually be the best outcome for all of your stakeholders as well as yourselves in retaining a client. You guys are so important as the bookkeepers. You're on the front line. You're having daily conversations, well, sometimes daily conversations with your clients, and you get to know a little bit more about their business and the challenges that they're facing. So when we get the accountants and the bookkeepers coming to us earlier, that leads to early intervention, which gives us more options to deal with the client. So that could be the difference between the business going through a terminal process like a creditor's voluntary liquidation, or potentially, if the circumstances are right, we could look to rescue the business through an administration. That doesn't necessarily mean that a business can't be recovered through an insolvent liquidation. We are able to sell businesses back to directors and give them a second chance at business, which again means that you would get a new client off the back of the company going into liquidation. There's less risk to you and your client relationship if you're involved from the off. There's no nasty surprises, and together we can come up with a clear plan for your clients to deal with the situation that they're in, and hopefully with early conversations with an insolvency practitioner. Once we've completed our investigations, there'll then be fewer shocks for the directors for the activities that have gone before. We'd always have an open and honest conversation about how the business has been ran for the 2-3 years prior to liquidation, and outline any red flags that we see at that point. So it also protects you if we do get the company started again. If 6 months down the line, the directors are facing some issues because of some transactions that have taken place before, at least we're in a much stronger position to deal with them together. So since the IAB awards, I've had a number of very interesting calls, and they're just calls that might last 2-3 minutes, just with a quick question, or they might be some really techie questions about certain insolvency aspects. They're mainly insolvent leads or questions that come through rather than solvent liquidations. And some of those calls they didn't lead to instructions, but one that stands out. I've had a quick look, and the member's not on the line today, but one of those instructions that stood out, it really gave the client some food for thought. And when they thought that the business has come to an end, and they reviewed some of the transactions that had gone before, and working closely with the bookkeeper on an advisory piece and with the accountant as well, they actually have not proceeded, and they've not gone into a liquidation process. And whilst my line of business is to assist and place companies into liquidation, it's actually recovery that's the primary focus. So giving the client that food for thought and giving him those extra options, he really took his time to make the right decision and opted not to place the company into liquidation, tweaked a few things in his business. So that's a success story as far as I'm concerned. In addition to that, I've had 2 solvent liquidations. So my last coffee morning, I spoke about solvent liquidations, which are known as members' voluntary liquidations. At the minute, the tax that a shareholder would pay on exiting their business is 14% after taking into consideration business asset disposal relief. Come April, that increases to 18%. So we are seeing a huge influx of solvent liquidations coming into this office at the moment. Now, the savings there on capital gains tax for the clients is significant. And hopefully off the back of that, that leads to then some personal tax work for you guys going forward, some advisory and gathering the records to assist them with the completion of their year-end tax returns. We've then done one insolvency event, and we helped. The purpose for that, the client had 2 or 3 different companies, and they basically had one company that was loss leading and was taking away resources from the other 2 companies that were successful, and we quickly closed that company down and placed it into liquidation. And that's currently still in liquidation, but there were no issues found on that, so we will look to get that company dissolved within a couple of weeks. And there's one on here that I've not added, and I don't know why, because it's probably one of my biggest cases of 2025. But I did a CVA for a client of yours, and a CVA is essentially a business rescue where the company had substantial debts, and we essentially put those into a settlement agreement with the company's creditors over a period of 5 years, where the creditors will be getting back 100 pence in the pound. Now, your member was also a creditor, so they will be seeing an element of their unpaid fees coming back to them. But ultimately, they've retained a really good client. There's a really good business behind it. The company had a really bad turn of events and was really unlucky. But actually, there's a business there that will grow and will continue to grow with your fellow members. I guess the key point is that early conversations with me, they don't always lead to instructions, and that's okay. That's often the best result for all. But when they do, those conversations always lead to better decisions that are not rushed by the clients. And when they have time on their side, they can really get to the nub of the issue and really start to get into what potential problems there might be, and we always try and find solutions with them. So red flags, they are pretty standard. There are some that have changed as time's gone on, but the key ones are cash flow. Are you seeing that the cash is in the bank account and that it's staying at a similar level, or are you seeing that it's dipping into its overdraft when previously it hadn't? Arrears to HM revenue and customs. This is obviously a big red flag. We see a lot of insolvencies where revenue are left with 12 to 18 months worth of debt. I would say anything over 3 months is a red flag to be looked at seriously. Are they historically, have they set aside VAT monies and PAY monies to settle those liabilities as they fall due? And are they now using that money to pay suppliers? Now, I've put issue there in brackets. That is a bigger issue for the clients. It's quite a techie issue, but essentially, if they start to pay their day-to-day suppliers back ahead of HMRC for the VAT and the PAYE, which is a preference debt in a liquidation, the directors do put themselves at risk of the liquidator then turning to them to restore the position had they not paid their preferred suppliers, so that money can then be redirected to the proper channel to VAT and PAYE. Is the director's loan account growing? So are you seeing a year-on-year pattern where the loan account grows with no real plan to deal with that liability, which then brings on S455 tax, which then could cripple the business? It's then a tax that was never anticipated. Is creditor pressure becoming personal? Are they receiving personal threats? Are they having bailiffs turn up to the house as well as to the office? Paying some creditors and not others, that ties in hand with the VAT and the PAYE issue further up in the slide there. Does the company have any leases that they cannot exit because they've simply signed up to terms? As a liquidator, I can disclaim leases upon appointment, and so long as it's the right situation, we can put a company into liquidation to exit onerous contracts that are no longer suitable for the company. And the final one, which we're still seeing, are companies that took out the bounce back loan when really they shouldn't have, or didn't forecast just how much it would cost them to repay that bounce back loan even 5 years down the line. And now we're seeing companies that have no to little income and still have the continued costs of a bounce back loan. And we speak to a lot of people on a daily basis where they say to me, we've ceased trading in 2023 and we've just been paying the bounce back loan back from our personal bank account, whether that be £300-400 a month, and they say they just can't do it anymore. I mean, just as a quick note for the IAB members, for certain jobs that I've done for those IAB members, there's one of those that comes to mind, and on that we charged a fee of £3,500 plus VAT for them to close the company, and they then got rid of essentially a £20,000 bounce back loan, which they were still paying. Another common thing that we see with these inquiries that come through are director loan accounts. Now, a director loan account doesn't automatically mean ongoing, but your clients need to understand how these must be set out and how they're handled in a liquidation scenario. Now, it's common practice that small business owners will take out their salary at the minimum rate, and then also declare dividends, which are then journaled off at the year end. But of course, when a company is insolvent and it's not making sufficient profits and it doesn't have sufficient returns, reserves, I beg your pardon, they are usually building a director's loan account, and that director's loan account, or those dividends when the company's placed into liquidation, those dividends that they've had before, they are then deemed as unlawful. Now, there's then an accounting movement. Those monies that they've drawn will remain in their director's loan account, and that the director's loan account is something that I, as liquidator, will have to pursue. Now, when I'm made aware of a director's loan account with the client, I'll always take the time to explain the differences to them about drawings and dividends and wages and what were expenses, and how the repayment of a director's loan account might assist them without closing the company, or if they do need to still put the company into liquidation, I'll talk to them about how we will go about recovering that director's loan account. Now, I can't go into how we would settle director loan accounts, because every single director has a different circumstance, but there are many ways in which we can settle director loan accounts, and invariably half of my cases, they do end up in write-offs due to the amounts and that we're due to recover in the director's personal circumstances. But where we do reach solutions, we can do that with lump sum settlements, with monthly payments, or a combination of the two. So there are lots of different options. So there's four options really, but the way in which it's dealt with, once we've got to the bottom of that option, there's many different scenarios that we have to take into consideration. So for me, how can I help you to refer clients to me? So there's a lot of ways, and really there is no set answer for this. This could be a short call with you and the director where I'm present. That's how I've done it previously with a member, a colleague of yours. We had a Teams call, we were on the phone for an hour, we spoke through several different issues, and in the end we all walked away from that call. The director then sent me a few messages afterwards, and we had a little bit of back and forth before he's now on his way. You can simply just do an email introduction with both parties' contact details on there, or you can give me a quick call, give me the facts of the case and the telephone numbers, and I will then pick up the telephone and speak to your clients. Now, there's no charge for any initial advice. The only time that there is going to be a fee paid is if they make a formal instruction and they decide to place the company into an insolvent process. In some cases, if we are looking at a deep piece of advisory work where we're looking at a restructure, then we would look to charge an advisory fee. But again, the initial advice to even get to that stage is free. With the fee structure, I tend to work with the members on a fixed fee basis. So we will set out our fees, and again, they start from £3,500, but the maximum they really get to is £5,000 to place the company into liquidation, and that they're only if there are techie insolvency issues to deal with employees, and dealing with landlords that are tricky, and potentially dealing with a number of assets. And on occasion, where your directors, if they're the directors that are still paying a bounce back loan back personally, and that's their only liability with no assets, then we would look to do a fixed fee at the lower end of the scale, and we would enter into a payment plan with some of those directors, almost along the lines of what they've been paying on the bounce back loan, but maybe just do that over 4 to 5 months. So if you do refer a client to me, there are a number of items that would benefit me. Then they're not essential, and we can just talk on rough numbers. But if we could get hold of a creditor list before the meetings, that we've all got the same numbers to work from, a breakdown of the HMRC position and where they are with the VAT, PAYE, and any corporation tax, details of any leases and finance commitments, excuse the spelling on commitments there, and an estimate of the director's loan account, if any, so that we can work out what that might look like for them in the future once the company's placed into liquidation. Tell me of any threats of any CCJs or statutory demands that the company might have received, so that we can put a timely plan together. People do have more time than they realise when the company is insolvent, so long as they are speaking to insolvency practitioners. Initial calls, they tend to take around 30 minutes, but there is no set time. As I mentioned earlier, there was a Teams call with one of your members that was over an hour. It really is down to the individual and how much information they want to get from the initial meeting. So for me, that's it. They're my contact details there. I just wondered if anybody had any questions. I'd love to field them. I'll do my best with any questions that you've got. Thank you very much.
I'm doing a typical mute thing. I do have some questions, but I'm just conscious of the time as well. So thank you ever so much. That was actually very insightful and very helpful. And in my experience of dealing with IPs in the past and with yourself, Thomas, I think what I was shocked about many years ago working with them was how constructive the help is, and how it doesn't always mean this is the end of the road for the business once you reach out. There's often some quite strategic ways of saving the business as well. So I would encourage reaching out, even if it's a question mark or it's an option on the table. So yeah, no, it's definitely not just a death knell for the company. It can actually be a lifeline.
Yeah, and I guess with making tax digital as well that we've spoken about, you're going, rather than a director delivering you a shoebox of records at the end of the year now to siphon through, you're going to get these quarterly now, if I'm not mistaken. So you're going to have eyes on these records a lot sooner, earlier than you did before. So you've really got an opportunity to spot some issues, which hopefully will lead to a retained client.
No, absolutely. Yeah, no, I definitely echo that. So again, thank you. Can I ask you just put your contact details in the chat?
Yeah, of course.
Anyone to follow up with if necessary.
Yeah, no problem.
Thank you. And just to close off, I just wanted to touch on the Treasury consultation about AML supervision and that status, because I know there's an awful lot of chat and probably a lot of misinformation out in the marketplace as well. So if I just zoom out for a moment, has been a consultation around who holds the right to AML supervision in the UK. This has been ongoing for the last 2 or 3 years. There was an announcement towards the end of last year as a conclusion to that. Now, there were several options on the table. The one was, and it ranged from status quo, where the professional bodies retain that right to supervise. As you all know, we've been out to supervise you and inspect you on how you carry out your AML responsibilities. So there was a range of options, which went from status quo to the government taking that responsibility back in house. Now, what has happened is that the FCA will probably in about a 2-year timeline become the central body for AML supervision in the UK. I can't say I was surprised at the outcome. We have a Labour government. They tend to have a centralised way of working. And if I stand back, I actually fully agree with the decision that has been made. At the end of the day, the MLRs, the money laundering regulations, are law and they should be policed by government. Whereas ourselves as a professional body should be policing standards. Now, obviously, there's a huge overlap between those two things, but I actually think that provides quite a lot of clarity in the marketplace. And that's really is the IAB stance, so we will be continuing. So currently at the moment, all the professionals of bodies are working very, very closely with the FCA in this transition period. What I want to say very clearly, though, there is at least a minimum of a 2-year timeline before this comes into practice. So it is very much business as usual. And what we will do is keep you up to date with changes as they happen. Now, it's going to be a minimum of 2 years. This is going to be primary legislation, which has to obviously go through Parliament. It will be announced at the King's speech in the spring. Then obviously the legislation has to pass through Parliament before we even get to an implementation stage. And again, another very clear message there. The FCA are not clear and haven't concluded what that inspection process or how they're going to manage this. So if you are hearing rumours in the marketplace, for example, I have heard that one of the other professional bodies is batting about numbers like £2,000 to be supervised. None of it is confirmed. It's all hearsay at the moment. As and when we have proper information coming through from the FCA, we will share that with you. But my message is it is very, very much business as usual. You will still be inspected. Everything that's continued up to now will continue, and then we will support you as that landscape changes. But I just wanted to make you aware of what was going on. And so there will be changes in the future, but they aren't in place yet. Now, obviously, we're a long way down the line to anticipating this change, so there will be further education pieces and support as we go through that process. But just I wanted to have a moment just to share that, make sure everyone was clear about what's happening. But if you do have any questions, then please just contact the compliance team as always, and we'll be able to support you that way. Anyway, thank you again. Lovely to see you all. I shall let you all get back to your tax returns and all the good work that you're doing at the moment. And I shall see you all shortly. Oh, sorry. And one other thing, I did write about this in our magazine. So there's a double page. You can go and read what I think about it all there. So anyway, many thanks. Right. See you all soon.